Good day, everybody. Brian here from quantlabsnet.com. Today is March 19. So for the last couple of weeks, I've been putting up lots of videos on my channel regarding options and futures trading. This is specifically for futures or options on futures, um, not equity, not stock. So it all started here. Um, all the different tools that are available through what I'm developing. I wanted to go over more in detail on the option side. There's a lot more I'm still working on, but specifically, if you're a technical trader with indicators and stuff, like you're just doing it wrong. You're gonna make money, give money back, and you're just gonna be totally relying on an upswing market. With this, what I'm doing, it doesn't matter what market it is. There's money to be made under any of the conditions. So I'm going to show you how to properly forecast what goes on in the market. And one way to do it is in options, not futures, options. 80% will be in options. And there's a lot of micro options out there you can get into that kind of make it affordable. But again, too early days to know that. So I've got a list here of all the latest scripts I want to show you. I'm going to go in order and I'm going to talk about each one. And this will be a lengthy video. Hopefully you'll enjoy it, and I'd watch the whole thing to really learn how to properly make good money if you follow the concepts here. Lately, turn them into decent performing Python scripts, and eventually down with C++. And I'm going to say um, AI can really help you here for that. So let's look at the first one here is the core option concepts. Just as a note here, just well, it's really my, but let's see here. Just do this way. We are in a WSL. Um, okay, I had a. Let me do this so it's easier. The old true and tested way. Let's do that. Boom. Okay, so what we're looking at here, I'm using typically gold, um, and that's in a spreadsheet. I've talked enough about options chain data, which is really limiting in futures options. I'm not going to get into that. I might talk about it in a little bit more about it in detail. But here's our input. So this is a typical an option choice, probably a better word. Strike price 29.10, current price 29.18, premium 2019. So we're in the money there. So we have to look at both sides of the trade. You're gonna have a buyer, you're gonna have a seller uh, participating in this trade. In the buyer's perspective, here's the benefits for them. There's a limited downside risk because your maximum loss is going to be your premium paid. That's why I'm going to be looking at what would the typical premium be paid out for micro gold, micro something that's really worthwhile to take a chance on. So with this limited downside risk, the potential is quite easy to say, well, unlimited profit. There's like a lot of profit potential. But again, what you need to consider is the upfront premium cost, and the other thing is the time decay. Um, so you buy an option with a strike price of 29.10 and a premium of 29.18. So the seller, what they're doing is they get the premium up front, and that gives them the immediate income. So if you know how to play this game and you're very confident in your trading, you could just sell options. And there's a lot of people that do it and build wealth quite quickly from that. The risks are potentially unlimited loss if the price moves significantly against them. There's an obligation to fulfill the contract if it's exercised. So, meaning you collect the premium, but if you lose on that position, you have to pay out to the buyer of the option whatever their profit is. So you have to pay that to them. So it's a true market, a free market in an exchange environment. So there is that. Uh, so that's the first script. Let's look at the next one. Is contract value calculator. Okay. So here, what we're doing is we're calculating. This is not what institutions will do. Now, this can be helpful to retail or smaller traders if they want to pursue treasury or T bond or T bill as a safety trade. In the in any event, you're working with this LIBOR SOFR rate, and I'm able to download that. So let's say it's 4.37, right? So then you have the calculation, $1 million contract, and then you got to subtract the the contract amount, and then this is actually a monthly rate, but I should focus only on the annual rate. Divide that by 4 for the quarterly rate, and then you get your contract value on a treasury contract in the futures market. So that's what that script does. That might not really affect you. Um, so here we're going to look at a put option, and again, I'm not going to educate people here on options trading. Um, call option, put option. Okay, so again, you can always use the automation to work in your favor to assess your situation before you take a trade out. A lot of traders don't do this. So here we have a scenario with a high strike price. Uh, well, this is all mechanical. So again, this is all under development. Let's say you have a future price of 58.57. The cash price is 58.49. So we have no intrinsic value, which means if it's zero, it's expiring worthless. Um, so there's a net return of 58.33. So here, high strike price provides a strong price floor, limiting a loss during a price decline. So again, these are the type of strategies that you can play with, and understanding that. But if you're not learning it from the right resources, you're not going to know these things. One thing I can't really say a lot about when it comes to what I thought. I can't say if I thought or think Tasty Trader if it's great, because there's a lot of these concepts are not really talked about, and because of that, it limits your view of the options market and the opportunity in that. So as a result, you may trade blindingly in a way and not really get a bigger picture of what you should and should know. Okay. So this is one scenario as such. Now, I could be wrong on that. They put out a lot of information at Tasty Trade, so I can't really say. But to know this key takeaway is important. So another scenario could be a low strike price, more upside potential. So you have a future price 28.88, cash price at 28.88, sorry, 28.80, intrinsic values at $21, expiring worthless, and the net return is 28.86. So again, this is all in development. Okay, this is just the mechanics of it. You may see the wrong data, the wrong results, and if you do, please let me know. I'd be very honored if you tell me that. So if there's a price increase, again, this is the whole idea of doing these exercises, so you know, and this is the power of the automation, is you get to see things that you wouldn't see otherwise, and that's what a lot of these shops do. Just running simulations and forecasting off those simulations, um, measuring risk. And there's gonna be other videos I'll be doing on that and running risk against just not only positions but against the entire portfolio, or risk against open positions already. So as I said, if the price increases, we have an intrinsic value of being worthless. Net return 29.23. Key takeaway: lower premium allows for profit if profit rises, but offers significantly less protection risk if the price falls. So again, these are some of the pros and cons of each scenario. So again, what we want to do is choose the right strategy. If we have a price expectation where the bullish, where the expecting a price increase from a lower strike price, it's bearish, expecting a price decrease, favoring a higher strike price for stronger protection. Neutral, uncertain decision depends on the risk tolerance. And again, risk tolerance as well, risk averse farmers in this case, but could be miners on the gold front, or just people selling options with gold. May prioritize higher strike price even at higher premium. Market outlook, volatility, higher volatility generally makes options more expensive. But we are entering into a period now under current president and it's very volatile because of his erratic decisions, his erratic policies, and then reneging on them, and blah blah. It just creates uncertainty. Thus, we get the volatility. So let's look at the next. So we're now looking at a call option perspective. Okay. So again, these are all written in Python. Now, this scenario is that we have a buyer perspective um, and a seller of an option. So if we have a strike price of this is a buyer perspective, strike price 29.10, current price 29.10, premium paid 15.19. Doesn't sound right. No, it can be. So we have a limited downside risk, maximum loss equals premium paid, potential for significant profit consideration, upfront premium cost, time decay. From a seller perspective on the option, we have a strike price 29.10, premium received 15.19. Um, the seller will receive the premium upfront, generating immediate income. But as I said, if there's potential unlimited loss, if the price moves against that price that you sold at, and then there is an obligation to fulfill the contract if exercised. So we can have different scenarios where we can have a profit loss, future price 25, buyer price of negative, buyer profit is equal to negative 15.19, seller profits 15.19. So the future price at 30, and again, this is part of the scenario role playing that we can do with automation. Buyer profit at 15.19, seller profit at 15.19. Looks like it's all the same. But to put you through all of this, to consider it when you get real data working, uh, programming logic, then you see where I'm going with that. So let's see if this guy works. We've seen the payoff diagrams before in another video. Okay, so here you can see here this is a kind of out of whack, but we can see the strike price, payoff, and the effective sales price. Okay, and again, I can put this sale price of whatever it would be. This was kind of out of whack, but again, it's in development. But again, with those kind of charts, when you look at your platforms, namely TradeStation and Trader Workstation, they may not show you the break even, and that's what you want to see. Okay, so now we move into put option intrinsic value. Okay, a lot of people don't consider the intrinsic value. They don't know. Um, so here, so uh, so our intrinsic value is the future price minus the strike price. So here we have 29.10 the strike, 2019 at the futures, no intrinsic value. Intrinsic value is zero. The put option is out of the money. Intrinsic cannot be negative, hence it is zero. So we also have to measure time decay, premium minus the intrinsic value. The time decay reflects market expectation and market remaining until expiration. So you don't get that with any other real asset class where you can measure market expectation. Okay, you're kind of like basing it upon sentiment, where people do something like, well, I'll run a scraping program that will go against a data source and measure sentiment out of that. It's not real sentiment because you're just using data that is a hunch, really. Whereas if it's with a futures, an options chain or a futures contract, you can see the expectation on the market. Strike price is set by the exchange. So from that, you can see all the bidding, open interest, and all that from the market, namely institutions. That right there is forward-looking data that you can use to forecast the market and then come back with this market expectation. It's the only asset class that gives you that. So here's the important one that a lot of people use: option Greeks. Okay, so this is an important one that a lot of people use, and let's take a look at what it has. So here we have a typical Uh, a future contract, we can measure volatility, have a true range if we want. But this is the nitty gritty that we're after. People always go after delta, gamma, theta, and vega. Okay, so this is what they are. Delta measures the change in option price for $1 change in the underlying asset price. Call option is positive, 0 to 1, and a put option is negative at -1 to 0. So the gamma measures the rate of change of the delta. Okay. Theta measures the time decay of an option's value, typically negative, right there. And then vega measures the sensitivity of option price to a 1% change in implied volatility. Again, that comes from the Black-Scholes. I've done a video on that. Um, so these are your measurements on the Greeks that you can use to, again, build market expectation from that. All right, so let's go to the next one. This one's important because if you want to trade like a pro, you have a bigger account. This is what a lot of these traders do. Is they'll set a floor price on a future contract. So in this case, they'll use a floor price and then have a cash position and put protection. And the put protection enables them to have that potential unlimited profit. And then they'll overlay it with other prices as well. Again, you wouldn't get these type of elements with a strike price showing that or break evens. Some of them will show. So again, I'm just showing you that. Okay, that chart. So, all right. Next up, we have a couple more scripts here. There are a couple of scripts that I have that that are very worthwhile to develop. The problem is that they're using the option chain data, and this is what I'm going to show you here. I've shown this in another video, so I don't need to go into detail on that. That was my prior video on this, what you're about to see here. So this is nothing special, but you can see here we get simulated of the Greek analysis on simulated strike prices. Okay, um, and then you get the simulated prices as well on whatever the strike price is. Okay, so because it's simulated, it's not really valuable to do charts on this unless you're doing it for simulation. But for final charts and visualization, it's not worth pursuing until you get real market data. I have mentioned in the prior video that you can somewhat get the data via TradingView, and I'll just leave it at that. That's the future options chain data. So it is available for pretty well, very cheap. Just realize they're very strict on their terms of service and how you use it. All right, so I think this is the last script here. So here we could look at the option premium analysis. Anything that has anything underscore CAG change is what I've changed for my needs. Okay. So here, let's run this. In here, um, what's going on here is we have two call options. Do this with a put option if you want it as well. Uh, so in this case, just to let you know, I can get real world uh, futures, commodity, we'll leave it commodity spot data in an affordable way. I can get current real world example future contract data through Interactive Brokers Trader Workstation. Okay, that's not a problem. So being able to calculate strike, all that, because it's again the exchange sets that. It's kind of difficult to do that, but we can kind of play around with it again, simulate. If we were able to use real world data, makes it a lot more accurate. So let's see what this means. So we have a call option, future price $30, strike price at 25. premium at 5, intrinsic value at 5, time value at 0. This is now a June call where we have future price at 32, strike price at 25, total premium 7, 7 time value. So we can assess which one we go with based upon this data, all right, and which one's higher profit, less risk. And again, we can generate all of the um, uh, payoff diagrams for that. So that's what I wanted to show you, okay? So again, we've gone through quite a bit of these videos, and there's a couple of things to take away. If you're trading and want to make money in a more uh, accurate way, this is the way to do it. You will have to have a larger account for it, obviously, but your predictability is better. Okay. And out of that, we also have um, the ability here to use this if you're looking at career, moving into hedge funds, moving into HFT shops, anything in professional advanced finance. If you don't know your futures and options, you will not get past a certain point. This is essential knowledge. You'll be working on trading desks if that's the way you want to earn your keep at a high level. Your programming will be important. I'll be moving into that sooner than later, but that's going to be part of my private membership because I've now found ways to get into very, very low latency uh, coding when it comes to C++ and high frequency trading, but that's only going to be reserved for my members. And I'll get more into the membership down the line. It's cheap right now if you want to join it. Be my guest. Just go to quantlabsnet.com to see it. But this is a direction we're going in. As I said, we've got a course on this material, just practical and theoretical. But there's no programming. This right here, what you're seeing is the programming. People ask, am I going to release it? Probably, most likely not. It's for my own use, but I will be generating reports from it, which will be pretty valuable, I would think. So that's where we're going. That's the direction. And down the line, when it comes to live trading, I do expect to kind of approach with a C++, low latency way of trading. Um, and if I build enough people, yeah, I might do as a professional trader, go in and offer, more advanced solutions for people, but you got to pay. I mean, it's simple as that. My goal here is to help people design strategies for these markets, and maybe even be able to generate code for them based around that. Because the way the AI is progressing, the way things are moving, um, yeah, you quickly learn and get positive impact on all this. So I'll leave it at that. Let me go to my website. If you want to know more, I know there's a lot of doom scrollers out there that don't want to engage. That's fine, but you're just basically essentially chasing after new shiny toys. That to me, that's not productive, but whatever. If you go to quantlabsnet.com, go under learn, and then you just fill in your information. I mean, I've got a C++ HFT ebook. It's out. A couple hundred people have downloaded it. I don't think I've got one complaint yet. The thing is, there's a couple of options you have if you want to learn more. Okay, so in here we've got a $30 course. Okay, right here to just get a sample if you like the course. Okay, and my style. In that, you can go under my plan and pricing. If you really want to get advanced on the discount, that's what you want to go after. That's the membership I'm talking about, and this will go up without a doubt because of the level of data that I'm providing, the level of programming I'll be providing, um, because this is very lucrative. And I've already talked about in a prior videos, namely this one. And I purposely left this thumbnail. It's 2,500 per month, as you can see here. for a limited data, 2,500 for option chain data on futures options. With the more unlimited calls and lower high speed data, it's 4,000 a month plus licensing fee, and it's a 1 year term. This is right from the exchange, or it can be from the exchange or other providers, sanctioned by the exchanges like the CME. But these are the costs. They closely guard this because it is very expensive, and it's really only for those that are willing to pay to play. And you got to have a big account. So retail traders will most likely not have access to this. And even if they did, I don't think it'd be worthwhile for them unless you have a large, like six, probably more likely a 7-digit account uh, on that. All right, so I'll leave it at that. Thanks for watching. Have a good day. And if you got comments, let me know. If I'm wrong on stuff or you see stuff that's wrong, let me know. And obviously, join and subscribe to the channel. But it's more than that, as is shown on the website. Over and out. Later. Bye.